Imagine you started investing in 1998 during the euphoria. The world is going crazy over the internet. .com companies are popping up like mushrooms. You take all your money and pour it into trendy .com stocks. For a couple of years, your capital grows and friends are impressed by your genius pick. But then the year 2000 hits and the .com bubble starts popping fast. The Nasdaq drops almost 80% and half the companies just vanish. Even Bill Gates loses billions in a single week. The market is in shock. I watched friends lose fortunes literally in a matter of days. The internet was a real revolution, but overconfidence turned it into a bubble. Why am I telling you this now, decades later? Because today I sense a similar vibe around artificial intelligence. It's being called a once-in-a-lifetime opportunity, a new technological era. Maybe that's true, or maybe history is rhyming again, like it always does. John Templeton said, "The most expensive phrase in investing is 'this time it's different.'" So is it really different now, or are we in for a repeat of the past? Since millions of you started investing because of my videos, I owe it to you to be honest. Don't panic, but take a step back and look at three hidden forces. They are fueling a potential AI bubble while simultaneously creating opportunities. Force number one is the concentration of power in the magnificent 7 stocks. That's Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA. Together, they make up a huge chunk of the S&P 500 and drag the market along with them. They are competing for AI leadership, pouring hundreds of billions into it. Even if you own a regular index fund, you are already betting on them. Whether you realize it or not, your portfolio depends on the outcome of this race. Tesla, Apple, Meta, Google, Microsoft, Amazon, they are all increasing their AI budgets. In total, that's hundreds of billions of dollars a year, comparable to the GDP of entire countries. This spending fuels the economy and delays a potential recession. But the question arises, how long can this pace of investment continue? Forecasts predict rising spending on AI and energy in the coming years. That is exactly why it's so important to understand what is behind this boom. Force number 2 is the AI money machine and circular capital flows. Intel, AMD, and NVIDIA make chips. OpenAI and others buy them. Oracle and CoreWeave build data centers and rent out computing power. On the surface, it looks like a normal tech ecosystem. But look at the money movement between the big players and it gets alarming. Investors pour billions into OpenAI, which spent it at Microsoft and NVIDIA. Microsoft and NVIDIA booked a revenue, their stocks rise, and they invest again. Everyone shows beautiful revenue growth even though the money is just going in circles. It's like paying a friend to dig a hole, and he pays you to fill it back in. You both have 1,000 in revenue, but real value has barely changed. OpenAI is valued in hundreds of billions of dollars with relatively modest revenue. AI companies are currently burning cash faster than they earn it from services. The bet is that later they will monetize user attention and data. Ads in chats, integration into workflows, raising prices for corporations. Undoubtedly, there is real value and technology in these companies, but a significant part of current valuations rests on faith in future acceleration. Force number 3 is the expectation of infinite progress and the data wall. For a few years, AI made giant leaps, from cricket images to realistic videos. The market got used to thinking this is the new normal and will last forever. But AI has already eaten most of the publicly available internet data. To move forward, it needs new, more complex sources of information. If companies don't find a way through the data wall, progress will slow. Then expectations could collapse and the valuation bubble might start to deflate. There is a way out. It's not just more data, but more diverse experience. Humans learn through interacting with the world, mistakes, and lived stories. AI is currently deprived of this. It lives on what we have already created. I'm not a scientist, so I'll leave the details to machine learning specialists. Let's get back to the question that matters to you: what to do with investments. The resemblance to the dot-com bubble is obvious: hype, inflated valuations, belief in a revolution. The difference is that AI has clearer paths to real profit.
These aren't just websites with trendy names, but tools that everyone uses. So I won't say it's a pure bubble like in the late 90s, but there are signs of overheating, and ignoring them would be naive. It's important to admit we don't know if this is the start of the cycle or its final stage. What would I do in your shoes? 3 things. First, I would keep investing via auto contributions into a broad index fund. If we are at the start of the cycle, current prices might seem cheap years from now. I did that during the dot-com boom, and I don't regret it. Yes, the portfolio dropped when the bubble burst, but the market recovered later. The main thing is not to panic and sell everything at the bottom when it's scariest. Second, increase income. Look for a raise, a new job, a side hustle. Income is fuel for investments, especially valuable during corrections. When the market falls, fresh money lets you buy assets at a discount. Third, diversify. Don't put everything into one sector or one idea. The portfolio should have different asset classes: stocks, bonds, gold, real estate. You can add a little crypto and dividend stocks for passive income. A popped bubble isn't the end of the world, just a change of scenery. Those who understand this don't run for the exit, but carefully buy up value at a discount. If you want to dig deeper into how to make money during recessions, I have a video. Subscribe so you don't miss it, and I'll see you in the next one.